Hello and welcome to the question and answer session of IAS 19 Employee Benefits. This is CN Professional Institute. So in the main video, we solved questions, we covered all the areas. We looked at the short-term employee benefits, we looked at post-employment benefits, we looked at other long-term benefits. Then we picked the defined benefit and the defined contribution. We looked at them. We looked at curtailment, settlement, plan amendment, and then asset selling in the previous videos, right? In this session, we are going to solve more questions, right? So as the name implies, question and answer sessions. We are going to solve more questions. We have like 23 questions. If you're not able to solve all, it's fine. We solved some in the main video. So if you've not checked, I recommend you watch those videos before coming to the question and answer session. You have to just watch the main video and then you come and watch the question and answer session for better understanding. So you can check those videos out. We are going to solve some. We can't solve all the 23 questions, but we are going to solve and select some and solve. Right. So let's start with question one. Question one. Okay, so question one. The following information is provided in relation to a defined benefit plan operated by Root PLC. At 1st January 2024, the present value of the obligation was what? 140 million, and the fair value of the plan asset amounted to 80 million, and the fair value of the plan asset amounted to 80 million. So we have 2024, 2025. So we have the discount rate at the start of the year. We have the current and past service cost, benefit paid out for both years, contribution to the plan, present value of obligation at the year end, fair value of plan assets at the year end. So you have the fair value of the plan assets at the year end, and then the present value of obligation at the year end. And the requirement is determine the net plan obligation or asset at the 1st December 2024 and 2025, and the amount to be taken to profit or loss and other comprehensive income for both financial years. So this straightforward. Okay, we are doing the net. The question, we should do the net obligation or asset. Okay, so we have to listen to the question. So we have the define. So the question, we should do the net obligation or asset. So we have to listen to that. So we have the defined benefit obligation, the defined benefit asset, and then we have the net, right? Okay. And then let me put my net here. Okay. So we start. Okay, so let's start. So we are doing all our calculations in million dollars. Okay. So let's start with the opening balance. So with the opening liability, how much is the opening obligation? Okay, it's 140 here. That's the 140, and asset is 80. So 140, okay, and then we have 80, and the net is 60. The net is 60, which is a liability. Don't forget, because the obligation is more than the asset. Then we go to the next one, which is the interest, right? So we look at the interest cost. We apply what's the rate. The first year, 2024, is 4%. Okay, so what we are doing here is for 1 year. So let me write up here. Let's do it one by one. So let's do 2024. Okay, some do it together, but let's do it one by one. So the interest will be the 4% on the opening. So 4% on 140, and then that will give us 5.6. So we're cross-checking the figures. And then when we go to the asset, that will be 4% of 80. Okay, and that give us 3.2. And then the net will be 2.4. And this for 2.4 is net interest expense because the obligation, the interest cost is more than the what the interest income. So the 2.4 is interest cost, not interest income, interest expense, not interest income. Then we have the service cost. Okay, both the current and in the past. So service cost. If you come here, the service cost is what? 30. The service cost is 30. So 2024, service cost 30. And we said we add service cost to the obligation. Service cost doesn't affect the liability, the asset. Doesn't affect the asset. So here we are going to have 30 here, right? That is the 30 minus 0. That gives us 30. I've explained this, all this in the previous video. So watch. I've explained them in details in the previous video. This is the question and answer session, right? So I'm a bit fast. It's not really fast. Then let's check the contribution into the plan or even the benefit paid first. Okay, it doesn't matter. We can do the benefit paid before the contribution, but let's do it in order in which it comes. So we have the benefit first. So let's do the benefit. Benefit paid out, it was 20. Benefit paid out 20. And we said that reduces both the asset and the liability. So 20, 20, and then the net will be 0. So benefit paid doesn't affect the net. Then we go to contribution into the fund. So contribution into the fund 25. And we said that doesn't affect the obligation, but it affects only the asset. Okay. So contribution doesn't affect obligation, it affects only the assets. So when you come here, it will be minus 25. And the reason is that we said we are doing it the obligation minus what? The asset. And you get a net. So here is rather define, supposed to be define benefit asset DBA. So we have this one here. Then we have basically we've brought all the elements. We brought the opening balance, we brought the interest cost or interest income, we brought the service cost, then we brought the benefit paid out of the plan 2020, and then contribution into the plan 25, right? So we are done. Let's sum all and then get something we call the expected values. Okay, so we sum this one, we have this, and we have this. So let's do the expected values and see what we have. So the first one, with the first one, let me pick my calculator and verify. Okay, so it's 140 plus 5.6 plus 30 minus 20. I had a figure of 155.6. So we'll be cross-checking the figure. So the expected value is, so the expected value is 155.6 for the obligation, 155.6 for the obligation. And then when you go to the asset, it is and then when you go to the asset, we are going to have 88.2. So the asset is 88.2. Okay. And then if you come to the net, it is 67.4. Please cross-check the figures. So these are the expected values. Then we will compare these expected values with the closing values to get the remeasurement loss or gain. So what are the closing values for the obligations in the question here? Is obligation is 200, asset is what? 120. So the closing here is 200 and here is 120. Okay, and then the net will be the difference. So 200 liability, 120 asset. So we'll have a net liability of what? 80. Right, and let's come and get the difference, which we said is a remeasurement loss or gain. So remeasurement loss or gain. Okay, so with the remeasurement loss or gain, you see the liability, look at our defined benefit obligation. After doing everything, we had 155.6 here, we had 155.6, but it has increased to 200. So if liability increases, it's a loss. Okay, so we have a loss of what? 44.4 44.4 as the remeasurement loss. Then when you come here, the asset, the expected value is what? 88.2. 88.2. But the closing is what? 120. So asset has gone up. Asset has gone up. And when asset goes up, it's an income, it's a gain, right? So here we have a gain of the difference is what? 31.8. 31.8. So that maybe when you add the 88.2, 31.8, you get 120. And then finally, when you come here, so here you realize that the remeasurement for the net here, the one that's supposed to be the net here is supposed to be a loss. Why do we have a loss? This 44 here, we said it's a loss. Liability has gone up, so it's a loss. This 31 is a gain. But you could say the loss is more than the gain. So we expect a net loss, right? A net loss of what? 12.6. A net loss of 12.6. And you can get it from you can get from this side too, right? So this is it. If you check, let's see if it will work. This 12.6 here, it was this minus what? This, and we said this an expense. Let's check this 67.4 plus 12.6. Will it give you 80? Yes, it will give you 80 because this is 0, 1, and here's what? 9 and 80. So it's correct. So that's it. So this one here is, we said it's what? A loss, an expense, because you realize that the loss here is bigger than the gain, so the net should be a loss. So that's all with 2024. So these are the closing values. Okay. So the remeasurement loss or gain, we record it in other comprehensive income with the closing values recorded in the statement of financial position. Then let's do the extract. So the question, we should get a net obligation or asset. We've gotten the net. Okay, for 2024, the net is what? 80. The net is 80 for 2024, which is very simple. Then it's 80 for 2024, right? Okay, let's go to 2025. 2025. But before we go to 25, it says we should also find the amount to be taken to profit or loss and other comprehensive income. So if you want to check the amount to be taken to profit or loss and other comprehensive income, we said the interest expense here, this one, right? We record it in P&L as interest expense, interest cost, right? You know why? The service cost to P&L. So these are the two things, these are the two expenses we record in the P&L. Then when you come to the OCI, we record a remeasurement gain. We record the net of 12.6. Sorry, a remeasurement loss, sorry, of 12.6. It's a loss. Okay, so we record a remeasurement loss of 12.6. When we go to financial position, we record a net liability of what? 80. So these are the items. Okay, interest expense 2.4, service cost 30, both in the P&L. And then when you go to OCI, we have remeasurement loss of 12.6, and then statement of financial position, net defined benefit obligation 80 as a known current liability. Let's go to 2025. 2025, we are going to have the same headings or the same stuff there. So let me copy 2024 and let's bring it here. And I'm seeing people put it together, but like if it becomes complicated, if you try and put it together, if you master it, you can put it together. But for now, let's proceed gradually, right? So we have 2025. So 2025. So 2025, let's go the same thing, the same headings. We are working in what? Millions, right? So we have the opening balance, right? So what's the opening balance? The asset, what's the liability? What's the opening balance for the liability? Now you realize that the closing balance of 1 year becomes the opening for the following year. Okay, so when you pick 2025 here, the closing for 2024 becomes the opening. So look at the closing for 2024. The liabilities was 200, right? That's the closing liability for 2024, 200, and that will be our opening liability for 2024. So the opening is what? 200. Asset would be what? 120. Okay, the closing of 1 year becomes the opening here, 120, and it's also here 120. Then the net is 80, also from the previous year. That's the difference, 80, and we said this 80 is a liability. Then let's get our interest. So interest will be, if you go to 2025, it said interest is 3% here. Interest for 3%. So 3% on 200, or 3% of 200 will give us 6. And this an expense. And then 3% of 120 will give us 3.6, if I'm right. So we said 3% of 200 will give us 6, and 3% of 120 should give us 3.6. So the net will be 2.4, and this 2.4 is also expense because the interest cost here 6 is bigger than the interest income, what? 3.6. So the net here is expense, interest expense. Then we go to service cost. We go to service cost. Service cost for 2025 is 32. So it's 32. And we say service cost affects only the liability. It affects the liability, doesn't affect assets. So 32 minus dash gives us what? 32. And then we have benefit paid out. So we have the benefit paid out. Okay, it's 22. So 22, and we said benefit paid out affect both. So 22, and then here is also 22. And here we dash. Then contribution to the plan. The contribution to the plan. We said contribution to the plan doesn't affect obligation. It's the asset, the asset that we put the contribution to. So a contribution of what? 30. I hope you can see it. If you come here, 2025, the contribution is what? 30. So 30. And then here we are going to subtract what? 30. We're subtracting because we said the net here is we've made it the liability minus the asset. So here 200 minus 120, here 6 minus 3.6, 30 minus 0 is 30, and 32, 32 minus 0 is 32, 22 minus 22 minus 22 is 0, and then here 0 minus 30 is minus 30, right? So that's how we might do the net. You can do the asset minus liability, as I've explained in the previous video. This addition and subtraction, they're in brackets, and that it doesn't really matter. Just get the understanding. But normally, because we are doing the liability minus the asset, okay, if the net is in bracket, then it could mean asset. Okay, so we are done. Let's do our remeasurement, or let's get the expected value. So the liability 200 plus 6 plus 32 minus 22. So let's get the expected values. So when we underline what will be the expected values, so let's underline this one, and this one. So let's get the expected values. Okay, so with the liability, if you sum all, you get 216, which is the expected value. So let me make it expected value. So it's the expected value. When you go to the asset, 120 plus 3.6 minus 22 plus 30 gives us 131.6, right? So this expected value, and then the net 80 plus 24 plus 32 minus 30 should give us 84.4. 84.4. Okay, so these are expected values. Then we come and compare with the closing values, right? We compare the expected values with the closing values. I'm checking if I can push this in small so that we can do the calculation here, right? So that's it. Let me just cut this one here. Okay, so let me cut this one. Let me cut this one here. Okay, so the closing values. Okay, the closing values are in the question. If you go to 2025, the obligation is 230 and the asset is what? 140. So here obligation is 230 and then the asset is what? 140. Still obligation is bigger than the asset. So we are going to have a net liability of this. So now let's get the difference here, the remeasurement loss or gain. So the remeasurement loss or gain. Now if you check, the expected value for the liability is 206. Sorry, 216, but the closing is 230. So you see liability has gone up. And if liability goes up, what does it mean? So if liability goes up, it's a loss. So there's a loss of what? 14. Then asset, the expected is 131.6, but the closing is 140. Asset has gone up. Asset has gone up. And if asset goes up, then it is what? A gain. It's a gain. So we have 8.4 as a difference. 8.4, and then here it will be this 14 minus 8 point what 4. Okay, and what are we going to have? 5.6. So we have 5.6. So 5.6 here is a loss. It's a remeasurement loss, because the loss is 14. Loss from asset, sorry, loss from the liability is 14. Gain from asset is 8.4. So you see that the loss is bigger than the gain. This loss 14 is bigger than this gain 8.4. So we will have a net loss of 5.6. Right. So let me go and then underline, and then that's it. So the same things here. So these are the closing figures. Okay. So if you are preparing your extract, interest, the interest cost should be, we record interest expense of 2.4 here, then service cost of 32 in the statement of profit or loss. OCI, we are going to record this figure here, 56 and sorry 5.6 as a remeasurement loss, and the financial position are going to record 90 as the obligation, defined benefit obligation liability. So that's it with this question. Let's look at question 3. We solved this question 2 in the main video. It's on curtailment. Question 3 is the same as question 2, only that we have 2021, 2022, and 2023, right? And this is the full information relates to a defined benefit plan operated by Andrews. So we have the opening balances and stuff. So it's the same as the question 2. Solve it. Let me have your answer on the comment. Let me have your answer in the comment section. Let's look at question 13. Let's look at question 13, right? So question 13 says, CL Limited operates a defined benefit scheme for its employees, but has yet to record anything for the current year except to expense the cash contribution, which were 80 million. So can you see that CN Limited is making a mistake by expensing the cash contribution? Cash contributions are not expensed. We'll look at the element that's expensed, but normally we don't expense the cash contributions, right? We normally expense the interest and then the service cost. But we'll look at it. The opening position was a net liability of 45, which is included in the non-current liabilities of CN Limited. Sorry, so this is supposed to be what? CN Limited, right? CN, okay, CN Limited in its draft financial statement. Current service costs for the year were 50 million, and interest rate on good quality corporate bonds fell from 8% at the start of the year to 6% by 31st March 2018. In addition, a payment of 9 million was made out of the cash of the pension scheme in relation to employees who left the scheme. The reduction in the pension scheme liability as a result of the curtailment was 12 million. The actuary has assessed that the scheme is in deficit by 51 million as at 31st March 2018. So let's analyze them here. So we have the opening liability, which is net 45 million. Then we have the service cost 50 million. And then the interest rate they give us two, 8% at the start and 6% at the year end. The question is, which one do we use? Then we said a payment of 9 million was made out of cash of the scheme in relation to employees who left the scheme. So if employees left the scheme, what's the name? Curtailment. Curtailment, the reduction in the benefit or the reduction in the number of employees covered by the scheme. Curtailment. We solved questions on curtailment in the previous video. So this is curtailment. This is what? Curtailment. Then this is the reduction in the pension scheme liability as a result of the curtailment was 12 million. Was what? 12 million. Now they are saying that, okay, we said to get a loss or gain on curtailment, we compare the payment made, okay, the fair value of the asset made to them with the reduction in the liability. You compare the two, and the difference is the loss or gain on curtailment or settlement. Here, this is curtailment with what settlement? Because when they left the scheme, they've been paid. They paid him 9 million. So this is curtailment with settlement. We looked at it in the previous video. Okay, and we have the closing balance. So this is very, very simple. We can get our loss or gain on curtailment, which is just compare the 9 million with the 3 million. That's all. So let's start. Very, very simple. So this one we say guys the net. So this is the net. That's the defined benefit plan. Okay, the defined benefit plan is back at the net. So here's the net method. Okay. So let's start. So what's the opening balance? The opening balance is a net, which is 45 million. It's a liability, net liability. Then the interest, because the opening is a liability, if you compute the interest will be interest cost. Are you following? Not interest income. The opening is a net liability. So if you compute your interest on it, it will be interest expense. Then the rate we have 8% at the start and 6%. We use 8%. Why are we using 8%? 8% is the opening balance. And if you remember, we are finding the 8% on the opening balance. Do you get it? On the opening balance. The opening balance. We normally apply the interest rate on the opening balance, except cases where we have payments being made not at the end of the period, but either at the beginning or midway. In that case, such payment will also attract interest, right? I mean, we have such cases. But here, if you look at it, it's the opening balance. Okay, it's the opening balance. So we are applying the interest with 8% on the opening 45. So we have to use the opening rate because we are applying it on the opening balance. You have to use what the rate at the start of the year. Okay, so 8% of 45, which gives us 3.6. Then we have service cost, right? Current service cost is 50 million. So the question, just scan through. We're to that service cost. Service cost is 15 million, which is added to the net. If you remember, we added to the net. We looked at that because the net is a liability and service cost increases the liability or increases liability. Then the next one is, let's come and work on the curtailment. The curtailment, we said curtailment is a component of past service cost. Just past service costs are in two forms: curtailment and what? Settlement. Sorry, curtailment and plan amendment. So plan amendment and curtailment, they are component of what? The past service cost. So let's get the past service cost here. So this service, the first one is current. So let me add C to this one. Let me just write C, current service cost. Okay, we know this is the current service cost. And then the past service cost, the past service cost, which is the curtailment. So let's get the loss. Now, you realize that, okay, we said the asset paid to them was what? We paid them now what? 9 million. Are you following? But there was a reduction in the liability by what? 12 million. Are you following? It says the reduction in the pension scheme liability as a result of the curtailment was 12 million. So would you agree with me that here that there is a gain on settlement? Yes, there's a gain on settlement. Why is there a gain on settlement? We have a reduction of 12 million in the liability, but we pay them what? 9 million. So it means our liability has reduced more than we paid them. So it's a gain to us. Are you following? If we pay them like 20 million and the liability has reduced by only 12 million, in that case there's a loss. But here we are paying them only 9 million. Our assets, our pool, the money in our fund is reduced by only 9 million, but the liability is reduced by what? 12 million. And we say when liability reduces, it's a gain. So the liability has reduced more than what? The asset that we paid to them. So here there's a gain on curtailment. Gain on curtailment. And we said this is curtailment with settlement, and this is a gain on curtailment. And we said, okay, when there's a gain on curtailment, how do you treat it? If you've watched the previous video, the main lecture, we said if there's a gain on curtailment or gain on settlement, the gain is used to reduce the past service cost. Are you following? It will reduce the past service cost because past service cost is an expense. So if there's a gain, the gain should reduce it. In this past service cost, it is only the curtailment that we have the gain on the settlement. That's the only gain we have. So in this case, we have to less it. I follow. We have to less it to reduce our expenses, right? So that's how it is. There's a gain here, a gain on settlement. So that gain should be used to reduce our past service cost. And then here the question didn't really give us any past service cost aside the curtailment, right? So we use the 3 to reduce the expenses. You can deduct these 3 from what? The 15, because they are all service cost. Are you following? Huh. Curtailment is part of service cost, and then we said amendment also part. Okay, so if there's a loss or gain, it affects service cost. So we can use this gain to reduce this 15. So somebody can do it this way. We write only service cost. We will not split it between current service cost and past service cost. But just write service cost and write 15 minus again 3. Right. Then we go to contribution to the fund. How much is the contribution into the fund? Contribution to the fund of what? 80 million. And that 18 is what they've debited. Are you following? That's the mistake they've done. They've debited it to P&L, which is not so. Okay. Then we have, so I think we factored in everything. We brought the opening 45. We computed the interest on it. Service cost 15. Then the gain, this past service cost. A gain on settlement of 3 million. We lessed contribution. We said contribution to the plan reduces the net. Don't forget, it reduces what? The net. So we looked at the net. Then we looked at everything. So I'm sure we've brought all the values: 45, 3.6, 15, 3, and then 18. When you add all this, or you do your deductions and your additions, you get a figure of 42.6. Okay, you get a figure of 42.6. 42.6. Okay, so 42.6 is the expected value, what we call the expected value. 42.6. I hope it's 42.6. Yes, I'm sure. So it is 42.6. So the expected value is 42.6. Then we'll go and compare this 42.6 with the closing value. So what's the closing value? In the question they gave us, they said the actuary has assessed that the scheme was in deficit of 51 million. So deficit means net liability. Okay, so this is 51 million. So we have 51 million. And then there will be a remeasurement gain of, there's a remeasurement. Is it loss or gain? So remeasurement. So expected liability is 42.6, but the closing is 51. So liability has increased. So it's remeasurement loss. So here's a loss of 8.4. I hope I'm right. But just let's do it. I'm sure you guys understand it. So it's 8.4. We do it, and then that's it with it. So in our statement of financial position, we will have this 36 as interest expense. Then we have service cost here, which is the net of the 3. So you can just net it off and record 12 as your service cost in the P&L. Then the remeasurement loss of what? 8.4 in OCI, and then the 51 statement of financial position liability. Let's look at question 9. Question 9 says Hillary has a defined benefit pension plan and prepares financial statement to year 31st March to 31st March each year. The following information is relevant for the year 31st March 2023. So we have net pension obligation at 31st March 2023 was 55 million. As at 31st March 2022, the net obligation was what? 48 million, comprising present value of plan obligation stated at 100 million together with plan assets stated at a fair value of 52 million. So check. Since the obligation was 100 million, the asset was 52 million. So if you net it off, you come and get the what? The net 48. That's how they got the 48. Then the discount rate is what? We have it here. So the not we say we should apply 6.25 discount rate to what? The net obligation. It says the actual return on the plan asset for the year was 4 million. Current service cost 12 million. At the first March 2023, Hillary granted additional benefits to those currently receiving the benefit. So when you hear this, they granted additional benefit is plan amendment. Plan amendment. You can check the main video. Additional benefit. So plan amendment. Okay. Which are due to vest over the next 4 years and which have a present value of 4 million at that date. They were not allowed for the original actuarial assumptions, meaning that they've not factored this amendments into the value, so we have to do it. During the year, Hillary made pension contribution of 8 million into the scheme, and the scheme paid pension benefits in the year amounting to 3 million, and the scheme paid pension benefits in the year amounting to 10 million. So this benefit paid out contribution to the plan. Requirement says explain the accounting treatment of the Hillary pension scheme for the year to 31st March 2023 together with supporting calculations. So it is very simple. The only 10-year, in the previous one that we saw, we had curtailment with settlement. Here we have plan amendment. Okay, so this is also simple. We'll finish right now. So here we start with the opening balance. So we said we're told that it's net. So what's the opening? So the opening is, so here we are doing the net too. We are doing the net, don't forget. We are doing the net and the opening was 48 million. That's this one, the net opening at 31st March 2023. Sorry, 2022. So that's the opening. Then we apply the interest on the net. So what's our interest? The interest is what? 6.2%. I think 6.25%. Okay. So apply it on the net on the 48. And then that should give us 3. Okay. So 6.25% of 48 should give us 3. And then we have current service cost in the question. So we have current service cost of what? 12 million. So let me just make it service cost of 12 million. Then we said there's an amendment here. This amendment. Okay, this 4 million amendment here. They amended the plan to provide additional benefit to what? The employees. So it's amendment, and we said plan amendment is part of the service cost. Okay, so the 4 million amendment is part of the service cost, which is normal or mainly past service cost. So this one is the current service cost. So let me make it current service cost. So we have current service cost of 12 and then the past service cost. So past service cost of, that's the amendment, the 4 million amendment. So should be added. It's also past service cost. Okay, so we can just say past service cost. So we have 4 as the amendment. An amendment forms part of the past service cost. Here there's not like settlement where we have loss or gain. No. Additional benefits received or that will be received by the employees is part of this part of the past service cost, and it should be treated or should be added there. Then we have contribution to the plan. How much was made into the plan? 8 million. So contribution into the plan. So they made a contribution of what? 8 million into the plan. And we said contribution to the plan reduces the net. If you remember, we looked at this already. And then we have benefit paid out. If you remember, we said with the benefit paid out, it doesn't affect the net. Here we are using the net method, right? We are using the net. And we said benefit paid out does not affect the net. Why? Because it affects both asset and liability. It reduces both the asset and liability. So it has no net impact. Okay. So don't forget that contribution paid, you never touch it. So we have the opening 48, 3, 12, 4, and minus 8. Now let's go and check something here. So 48 plus 3 plus 12 plus 4 minus 8, right, should give you expected value of what? 59. Now look at something here. Let me wipe this in so that you can see better. Look at this here. It says the actual return on the planned asset was what? 4 million. Now leave that one and check something. Let's come back to the question and come and check something here. Now 48 plus 3 plus 12 minus and plus 4 minus 8. What do you get? 50 what? 9. So 59 is the expected value. Are you following? 59 is what? The expected value. If you analyze, you get 50 what? 9. 59 is the expected value, right? Now check something here. Let's go and compare the expected value with the closing balance. Let's compare the expected value 59 with the closing. So let's come here and come and check the closing. What's the closing? We've been given the closing the question. I hope you can see the closing. The closing is here. It's what? 55 million. That's the closing. 48 is the opening, and then 55 is what? The closing, which we said it has both the asset and what? It has the asset and the liability. So when you net the asset and liability, okay, that's what give us this 48. iPhone in the opening. That's what give us what? The opening 48, right? Okay. Now let's check this one out. So we have the closing to be what? 55. With this 55, what will be the remeasurement loss or gain? Could you see that the remeasurement loss or the remeasurement figure here will be a gain? Why is it a gain? What we are doing here is net, and it is a liability, net obligation. So the liability has gone down. The expected value is 59. The closing is 55. So the liability has gone down. So this is a remeasurement worth gain of how much? 4, which we expect to reduce the obligation so that when we deduct, we'll come and get the closing, because we said a gain reduces what? The liability, right? Can you see that this 4 here, remeasurement gain here, is the same for here, which is the return on what? The asset. The 4 million return on what? Asset. So this 4 million return on asset is the remeasurement gain. Are you getting it? And it was a gain because, can you see, it reduces the asset? So there are some questions where the actual return on the planned asset becomes our remeasurement loss or gain. Are you getting it? It becomes the remeasurement loss or gain. We'll look at more questions like that, but just have to know that the difference of 4, okay, the difference of 4 here is the remeasurement loss or gain, which is the same as the return on the asset in the question. Are you getting it? So that is it. We'll solve more questions in the subsequent video so that you really get to understand this. But that's it for this one. So if you append your extract, interest expense here, this 3 million is interest expense, which will go to P&L. Service cost 12 million P&L, past service cost 4 million P&L. Then the contribution can affect your cash if paid. Then we have a remeasurement gain of 4 million, which we record in other comprehensive income, and record this 55 closing figure as net obligation in the statement of financial position as non-current liability. Non-current liability. So that's it about this question. And that's it about this question. Even there's a breakdown for this 4. If you want to get a breakdown of the 4, okay, the remeasurement here, this 4 with return on the asset, okay, pick your opening asset. What's the opening asset? Can you see the opening asset is what? 50 what? 2, right? Your opening asset is 52. If you apply the 60, what was the rate? The 6.25% on the 52. Okay, 6.5% on the what? The 52, you get 3.25. You get 3.25. Now come and compare. That's the return. That's the return that we are supposed to get on what? The asset that's expected. But we're supposed to get if you multiply the 6.25% on the opening asset, we are supposed to get return on asset of what? 3.25. That's supposed to be the actual return. I mean, that's supposed to be the expected return on the asset. Are you following? It's supposed to be what? 3.25, because we said the asset is 52 million, the opening is 52 million, and then the rate is what? 6.25. So when you multiply the 6.25 by the 52, you're supposed to get what? 3.25 million. Are you following? But we're told that the actual return is what? 4 million. So you realize that there's a difference of what? 0.75. Are you following? In excess of the expected. Because the expected, you said, is 3.25. But the actual here, the one that the question is 4 million. So you realize that there's an excess of what? 0.75 from the fund. But the truth is we have to use the total 4 million as the gain. Are you following? And that would be the actual return on the asset. And that's what we are going to use as the remeasurement loss, because it's the same as the remeasurement. That's what we are going to use as the remeasurement gain, because it's the same as the remeasurement gain, right? So there's nothing wrong. There's nothing difficult about this question. Okay, so let's pause here. And the second part, we'll have another video, or there'll be another video on still on the question and answer session. So in that question, we are going to solve question 23, which is a bit complicated. Okay, we'll solve question 23, and then we will also look at question 12, 8, and 4. And that'll be it. When we are done, we know that okay, this one they are very solid on IS 19. Like we are really cool, or we really understand IS what 19. So we'll have another session with the question and answer session where we solve this question, the graph PLC question. It's a very nice question, has everything some, right? So I'll see you in the next video, or I'll see you in the next session.